Hello guys and welcome to the moon. My name is Carl and I'm going to bring you this cryptocurrency video. And today is of course a very strange day where many people don't really know what's going on. But yeah, the title is true. I actually lost $1.6 million worth of Luna because I held $1.6 million worth, and now the price has gone down, and it seems like we're going closer and closer and closer to zero, which means that I very soon have nothing left of those Luna. Yeah, so essentially, this is the Luna chart right now. You can clearly see that this is a yeah, it looks almost like BitConnect, to be perfectly honest with you. So yeah, I lost 1.6 million. I just got a call from another guy who also lost money. I think many people out there are in the same boat. Many people lost a lot of money on this in this fiasco. So sometimes these things happen. Personally, I'm fortunate enough to have assets elsewhere. This was just a fraction of my net worth, but I do understand that some people may actually have had a significant amount of their net worth in Luna or UST. And for those people, I'm very, very sorry. It's very, very tough. I hate when these things happen because, of course, money is just material things, but when you lose money like this, it really feels really, really bad. So I understand, guys. Even though this was not a big part of my portfolio, I still felt sad about it, of course, because that's 1.6 million. I could have bought, I don't know, 10 cars. I could have, I don't know, I could have done so many different things with that. I could have invested in a business. I could have bought Bitcoin with it. I could have, there are so many things I could have done with that money, and now it's gone. So it's not nice. It's not nice. But I am not bankrupt, guys. That's for sure. That's for sure. Let's take a look at the UST. This is the stable coin of Luna, and it was stable for a while here, but now it looks almost like any other shitcoin out there, and this is of course incredibly sad because yeah, again, this is how people lose money. Right now, this stable coin, quote unquote, is down at 44 cents. Some people are speculating that UST will eventually go back up and get repegged to $1. So some people are buying here, but you know, that's a risk. That's a casino. That's a gamble because I have no clue what's going to happen in the next few days here. If you do want to buy or sell UST or Luna, you have my Binance link down below this video, and you can also go to Bybit because Bybit is
going to be able to hike as much is certainly part of the thinking in some traders' minds. Certainly those who are short, and as the yield curve, as yields get higher and higher, it does become more costly to get short as well. We have to remember that it was really easy to get short when you weren't paying anyone a coupon. Now that you have to pay someone a coupon, it's a little bit harder to stay short for a prolonged period of time.
What does this mean, Ira, in terms of how violent the reaction in markets could be to a big surprise one way or another to today's CPI print?
Yeah, I think the bigger risk at this point is, inflation is a little bit higher than the market expects, and once that happens, I do think that you wind up getting some at least one more hike priced back in. So you can wind up seeing that 3-year and 5-year part of the yield curve probably sell off pretty aggressively, especially given that it's outperformed so much over the past couple of days.
Ira Jersey, we've got to leave it there with Mike McKee entering the building. Mr. Jersey with Bloomberg Intelligence. Joining us now, Michael McKee, who more than anyone I know in the economics racket is attuned to the zeitgeist right now. His trip to Palo Alto, the Hoover Institution, and to Amelia Island with Bostic and the Atlanta Fed. Mike, what did you learn? Why is this inflation report different from LBJ 5% or, as we mentioned earlier, Carter 12%? What's different this time?
Well, in a way, it isn't different because the Fed still has to attack a problem that is very difficult to attack because half of the inflation is supply side, roughly, and the Fed can only work on the demand side. So they admit it's going to be more difficult than just bringing down inflation, but they also do not want to have the kind of recessions that came after the Carter years.
How do they do that? What is the mechanism for Loretta Mester, who you've talked to in the last 24 hours? How does she at Cleveland manage down economic growth? I don't understand how you do that.
Well, they have two thoughts. One is that they need to get to neutral, define that however you want, by the end of the year very quickly, so that they are putting some pressure, downward pressure on the economy. And the other is that the economy is so strong with jobs and unemployment where they are, they have room to move. They can move up without as much danger as in the past.
Mike, you're one of the best at this. You'll break this number down for us in about 7 minutes' time. We'll get 4 different CPI figures, Mike. What matters to you? What should we be focused on?
Well, I will tell you what matters to the Fed and to Jay Powell. They have said, and they reinforced that in our travels over the past week, that they are looking at month-over-month CPI core, because they want to see improvement there. If you're looking at month-over-month and it comes down in at a slower pace, it suggests that inflation is slowing down, and that will take out the base effects of a year ago. So it'll be a much more clean read on inflation. So while Wall Street may focus on the year-over-year number, the Fed's going to be looking at the month-over-month numbers to hopefully see some movement lower.
Mike, awesome. Looking forward to coverage. 6 minutes away. Just going through the estimates, 8.5%. And the previous read year over year on headline. Only one bank has a forecast of 8.5% again. It's Holger Smeeding over at Berenberg. At the low end, you've got Ethan Harris of Bank of America looking for 7.9. To Mike's point, Tom, core CPI month on month. If that's what the Fed's following, the market's going to queue off that too.
You know, we talk about the consumer and Main Street, but to be fair, that is what you do in academics. You do look at the short term, the rate of change, if you will, of of inflation, which is its own growth rate.
Lisa, we're looking for deceleration.
Yeah, deceleration, but in what, right? I mean, does it matter if it's deceleration in some of the non-core items, the idea of energy driving this and some of the fluctuations in gas, or really are people looking at lodging? Are people looking at airplane tickets? Are people looking at wages? How much does that really end up being the driver that determines a much greater proportion of, frankly, the Fed response?
So the number in 5 minutes, Tom, and then the breakdown with Mike McKee and Mike Dada, too. Great guest coming up.
Well, it is, and it's about this balance between the nominal economic and the nominal rate and the inflation adjusted rate. So it's not just one moving part here, folks. It's really three items moving around. The word I use, John, very sophisticated, is this is a squishy report coming up.
Mike Dada, the chief economist and macro strategist at MKM Partners, joining us very, very shortly. Futures up by a little more than 1% on the S&P, and the NASDAQ up by 1.4. Yields are not higher, they are lower for a third straight.
We all come into this world with potential, and the more of it we can tap into, the more we can do. That's why we design ETFs to unleash the potential in investors, so they can pursue whatever goals they set for themselves, no matter how ambitious. Get your share of progress. iShares. Invest in something bigger.
Session. We're down by 4 or 5 basis points to 294.61. The inflation print in America up next on Bloomberg Surveillance.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize
New York City this morning. Good morning to you all. Going into that information, that data point, futures up by 1% on the S&P 500. On the NASDAQ 100 up by 0.8%. With your data, here's Mike McKee.
All right, here we go, John. CPI on a month-over-month basis up 0.3%, which is certainly down from 1.2% last month, but a little bit ahead of the forecast. The less food and energy, the core up 0.6. Now that is an upside miss that is not going to make markets or the Fed happy. 0.4 was the forecast, 0.3 in the prior month. On a year-over-year basis, we're at 8.3%. That comes down from 8.5%, and core is at 6.2%. That comes down from 6.5%. Now the thing to keep in mind is those year-over-year figures are based on a the drop is based on a base effect, the fact that inflation was so high in these months last year, it was mechanically going to fall. But the month-over-month numbers come in a little hotter than the Fed expected. Right now, it looks like food was up 0.9%, the 17th consecutive monthly increase. Food at home up 1%, down a little bit from last month, but it is still a significant jump. Energy down 2.7%. People had predicted that. Gasoline down 6.1%. That's in part seasonal adjustment. So it is something that could turn around as we see gasoline prices rise again into the summer. And shelter increased 0.5%, rent up 0.6%. Owner's equivalent rent now 0.5%, and that is not good news. It suggests housing prices still are weighing on the overall index. I'm just looking here very quickly. I'll let you do the markets. I'm looking for the autos. Let me
keep digging, Mike. Yeah. Keep digging. I need to pick up on this price action. One number matters right here. Month on month, core CPI 0.6. The previous read 0.3. The median estimate 0.4. The range on Wall Street anywhere from 0.3 to 0.5. No one was anywhere near this, Tom. No one called 0.6, and that's why this market moves the way it has done. Down 0.25% on the S&P. On the S&P going into this, up 1 full percentage point. The NASDAQ lower by 0.5%, and off to the races at the front end of the yield curve. Your 10-year up 3 basis points after being lower. TK, take a beat. We're up 8 basis points on the front end. Your 2-year up 8, your 3-year up 9. Your 5-year up 6.
Berenberg Bank, you mentioned John Holger Schmieding and the great Mickey Levy. These are wow statistics. And John, real average weekly earnings negative 3.4% is stunning. And I wonder, John, not that the president knew the details, but you got to wonder if the White House got a heads up on this 3 or 4 days ago to give him 2 days of FaceTime to start managing the message.
I'd suggest not a ton changes for the president later because gas prices were where they are. That was already a massive problem for him. Wall Street will be talking about a 0.6% core CPI month-on-month figure. Main Street will even talk about 8.3. It's down from 8.5 in a previous month. So you've got your peak inflation if it's the 8.5. The problem is we don't have the scale of deceleration, Lisa, that this market economists on Wall Street we're looking for. And again, we go back to the start of this morning. It's not about where it peaks, it's about where it plateaus and how much deceleration we get through the summer as this Fed looks set to reassess at the end of August. And right now, 0.6% month on core is a problem.
If this is deceleration, it's not working. It's not going to help the Fed in any way, shape, or form. They're going to have to be more aggressive. And the fact that it's coming from rents, the fact that it's coming from wages, the fact that it's going to the fact that companies can keep raising prices and not meet resistance is something the Fed will need to address that they cannot blame on supply chains and oil shortages.
And Mike McKee, you're wonderful at this. The year-over-year stuff, it's base effects, it's mechanical. The month-on-month, to see that 0.6, Mike, how surprised are you?
I'm not surprised because some analysts had forecast we might see that because of some statistical quirks in the data that do appear to have shown up. The BLS changed its methodology for estimating new car prices, and just starting this month, and new car prices went up 1.1%. It had been 0.2, 0.3 beforehand, and so we have a big jump in new car prices that is a methodological change and will eventually work its way out of the numbers. Used cars fall again, second month in a row, down 0.4. So not so bad. Airline fares up 18.6%. Well, if you've been in an airport lately, like I have, everybody's flying. So the airlines are making up some ground there. We also saw natural gas up 3.1%. So seasonally adjusted going the other way from gasoline.
And Michael, I'm looking at one of the interior data points you're expert at. And let's say there's 40 lines, folks, of the inflation we're living. I can make a joke about alcoholic beverages, but let's move on from the joke. Apparel up 5.4%. New vehicles, you mentioned, up 13%. Physician services go nowhere. Hospital, I mean, it's a jumble. It's a mix. What do the pros do with a jumble that we see here?
Well, what you're going to be looking at, besides the month-over-month headline change, is the month-over-month changes in core goods that people buy on a regular basis, try to figure out
the Cleveland series or the Dallas series.
Well, you could look at that. Apparel prices down 0.8% on the month over month. So maybe that is some deceleration. And that's what you're going to be looking at to see if prices are starting to come down in some key areas. And of course, nobody expects it to fall off a cliff. This is by the end of the year, they're hoping to get somewhere between 4 and 5%. So we'll see how this continues to play out. Part of this is going to be the supply chain problems. Maybe now we've got clothing in the stores because we didn't have it in the fall.
Mike, you just got finished with hobnobbing with Fed officials, with academics. We're looking at a surprise to the upside. This is not what they want to see. They say they are data dependent. Is this enough data to change views, to get people to actually be more persistent in terms of the pace and the duration of the rate hikes?
No, this isn't going to change anything. This is sort of on point what they expected. It's not what they want, but it is certainly something that they are not going to be surprised about. And some of the things that pushed up prices are things obviously the Fed can't do anything about. They're not looking at the year-over-year numbers on the headline. Even that's what Americans are going to look at. That's what's going to be in the headlines in the newspaper. But people are going. The Fed is going to be looking at where the inflationary pressures are coming from, and they'll disregard gasoline and food.
Mike, a nuanced view from you, as always. Wonderful work. Thank you, buddy. Futures are down by 0.25%. They were higher by about 1% on the S&P. NASDAQ 100 futures are negative 0.7%. Seeing this bleed into the bond market a little bit. 285 was the high on a 2-year yield last week. We're back to 271. We're higher by 10 basis points. So quite a move there, but off the highs of the year so far. TK, I'd go with Mike. Not a game changer, but it certainly keeps the heat on this Federal Reserve going into the next meeting and beyond.
Michael Darda joins now, chief economist, macro strategist at MKM Partners. Michael, you and I had a scintillating conversation 5 or 6 days ago about the nominal nature of the American economy. This kind of inflation, if we see it over 1 month, 2 months, 3 months, what does it say about the combination of real GDP and inflation?
Hi, Tom. Yeah, I think, these numbers obviously are too hot. So, this is a bit of a shock to the upside. But I'd actually go to the point that, that Jonathan just made, where the peak, which looks like it is in now on a year-over-year basis, is potentially a lot less important than where these numbers settle or where the plateau is. And if we have really rapid nominal GDP aggregate demand, even if these year-over-year numbers were to come down by half, right, and we settle around 4% or just above that by the end of the year, and it looks like that's the plateau, that's still a major problem for this bond market, a major problem for this Federal Reserve, and as we're seeing, a major problem for the valuations that support the S&P 500. They are going down, and they are going down because long-term interest rates have been going up.
Mike, does that landing strip for a soft landing just get that little bit narrower with this number?
Yes, I think it does. The Fed has its work cut out for it. It does need to slow aggregate demand. And typically, starting from behind the curve, the success rate isn't very high. So usually what happens is central banks start off too slow when they're behind the curve. That's the definition of being behind the curve. And then eventually they apply too much braking force later on. And that's, typically when you're in a bust part of the cycle. So I don't think that part plays out this year. but they've missed the boat a bit here. I think it's pretty obvious now. They really should have gotten the tightening process going last year. And then even, with that press conference last week, Powell seemingly, explicitly ruling out greater than 50 basis point moves. I mean, why rule anything out in the early innings? Step away from the forward guidance and, take it meeting by meeting. So I think the message was a bit bungled and confused as well, and that is not helpful in this environment.
There's a big debate, Mike, about where the drivers of inflation are coming from and how much is really within the Fed's control. And that's perhaps underpinning some of the hesitance for a more aggressive approach by Fed Chair Jay Powell. How much do you agree with that the bulk of the inflationary pressures are coming from overseas, from supply chain disruptions, from geopolitical issues, and not from the dynamism in the labor market, from the willingness to spend, from consumers that still have a lot of cash?
Yeah, it's confusing because we do have these supply side shocks playing out, and those shocks are raising inflation, and the Fed cannot do anything specifically about those shocks. But we've also had a super robust nominal GDP backdrop, and nominal GDP is robust to supply side shocks, meaning that a supply side shock will change the composition, but not the level or growth rate of nominal GDP. So, we can actually get to a rough and ready answer to that question